Hello, everyone. Welcome back to the Weekend Charts special edition today, the State of the Markets, August 2025. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today. A lot to talk about: stocks, bonds, the Fed, real estate, housing, commodities, currencies, crypto, intermarket analysis, and we'll end with the U.S. economy. So we're going to do an overview of all of these different areas. Definitely stick around to the end. We'll start here with the stock market and three major U.S. indices. You can see at the top panel, NASDAQ 100 back at all-time highs, recovering from the bear market fully. S&P 500 back at all-time highs, recovering fully. Small cap Russell 2000 still lagging here, not back at all-time highs, even though it's well off of the April lows. If we look at the S&P 500, 15 more all-time highs in 2025. That follows 57 in 2024, which was the fifth most of any year in history. And what's driving the market higher once again is the story surrounding underlying fundamentals and earnings. And earnings in second quarter here, 79% of companies reported are set to hit another record high, up about 10.6% year over year. And the expectation is this is going to continue in Q3 and Q4, with the S&P 500's earnings growth right now expected to be about 11% for the full year in 2025. And the big driver, once again, are the biggest technology companies, all really exceeding expectations in terms of earnings in the second quarter. So following up on the strong first quarter, another strong quarter in Q2. So if we're looking at year-over-year growth rate here in terms of the S&P 500, 11%, so well above the historical average, was about 6%, and this is the 10th straight quarter of positive earnings growth for the S&P 500. If we look at valuations here, this is the but part. Valuations are definitely expanding, and that's simply because prices are running up ahead of fundamentals. This is a little surprising given what happened back in April when multiples were very briefly contracting during the bear market, but stocks have rallied so much, so fast since the April lows that valuations are actually expanding once again here. 26.1 for the price to peak earnings ratio on the S&P 500. That's the highest that we've seen since 2000, and over 50% above the historical median, which is around 17.2. Many different ways to look at valuation, of course. What I'm showing you here is the price to sales ratio, which just hit a new record high, surpassing the prior high from 2021. We're at 3.15 times sales for the S&P 500, almost double the historical median. And what's driving this price to sales ratio higher is the narrative of higher margins. If we look at the biggest tech companies, almost across the board, seeing significant margin expansion. That's pushing up margins for the S&P 500 as a whole, 12.6% for the second quarter, well above the historical average, highest levels since 2021. Another way to look at valuations is to smooth earnings over a 10-year period, so you're not really dependent on 1 year's worth of earnings, which can be volatile. And that would be looking at the CAPE ratio or the the Shiller PE, so coined by Robert Shiller. He developed this methodology that smooths earnings over a 10-year period, and this ratio has rarely been higher than it is today, approaching 38 here only in 2021, very briefly before the 2022 bear market, and in the late 1990s and early 2000s around the peak of the dot-com bubble. Those are the only two periods where this valuation metric has been higher. So the question, of course, is what do high valuations mean for investors? And the answer is, in the short run, absolutely nothing. Very little correlation between the S&P 500's valuation and short-term returns. So looking out 3 months, 6 months, 1 year, even a few years, there's really nothing you can say about future returns looking at valuations alone. You have to go out further. Looking at 10-year forward returns, you start to see a relationship here. You can see at the extremes, when valuations are at their highest levels, you tend to see below average future returns. And when valuations are at their lowest levels, you tend to see above average future return. So what do high valuations today mean? If you're just looking at the odds, they suggest that over the next 10 years, that investors will experience below average returns going forward. And that's assuming that the the multiples are going to have a mean reversion. We're going to see a lower CAPE ratio 10 years from now than today. That's in that assumption because that has happened in the past. If you don't believe that's going to happen, if you think valuations will stay the same or go higher, then that wouldn't obviously impact future returns. But the most likely scenario, looking back at history, is that we'll have some type of mean reversion going forward. Looking at the U.S. versus the international stock market, you can see entering the year, it was just a huge period of outperformance for the U.S. stock market, over 16 years of outperformance, by far the longest period of outperformance that we've ever seen in history. And then on a dime, it just flips. In the early 2025, international stocks start outperforming the U.S. stock market, and you can see it was extreme in the first quarter. That outperformance among the biggest ever in terms of quarters looking back at history. And since then, we've seen a little bit of a recovery in terms of the U.S. stock market closing some of that gap, but the gap still pretty wide on a year-to-date basis, 20% return for the international stocks here, excluding the U.S. stock market, over 2x the return of the U.S. stock market, 8.6% for the S&P 500. And we've very rarely seen the U.S. stock market in the past decade plus be in this right column here, which is the bottom third of global equity ETF performers, up about 8.5% this year. You could see what's leading. Well, definitely Europe, the Eurozone, the top 4 country ETFs all in that area. Greece up 69%, Poland 63.5%, Austria 52.6%, Spain 52%. So enormous returns, totally unexpected entering the year. Looking at the Eurozone here, ETF up 29%, and nobody was predicting this type of huge outperformance in terms of international over U.S. And it's really been a rising tide that's lifted most of the countries here. So if you were going to go back to April and look at the carnage around the world, and particularly in the U.S., and a lot of the rhetoric around tariffs and potential global recession and trade being restricted, no one would have predicted these types of returns for equities around the world. But here we are, very few countries in the red. Most of the stock market's not only up, but up big year to date. If we're looking at the Magnificent Seven, the big story this year has been the dispersion within the Mag 7 names. Not everything moving together as we've seen over the past few years. These stocks would move together on the upside and on the downside. This year, we're seeing a few stocks really outperforming. NVIDIA, Meta, Microsoft really on the AI narrative, really outperforming the S&P 500. NVIDIA leading the way here, 34.6% gain. On the downside, Apple and Tesla actually in the red, down year to date. So viewed as not benefiting as much, obviously, from the AI revolution. Tesla, of course, struggling here with its sales in terms of the number of vehicles it's selling, going down over the past year, and earnings really contracting there as well. Now, the outperformance of NVIDIA, Meta, Microsoft, and other growth stocks has actually driven the ratio of growth to value for the Russell 1000 to a new record high, surpassing the peak from March 2000. So this was when the dot-com bubble peaked. You can see that huge surge higher in growth stocks versus value stocks. You could see the crash thereafter, and growth has been outperforming value by a huge margin over the past 15 years. And here we are actually surpassing that peak from March 2000. Stunning to see, but the leadership story remains concentrated in large cap U.S. growth tech stocks. And here's the visual of that. The technology sector versus the S&P 500 also hitting a new record high here, above the high from March 2000. So if we're looking at sectors year to date, this wasn't the case back in April, but you can see tech now outperforming the S&P 500, up 13.6% versus the S&P's 8.5% gain. everything in the green with the exception of healthcare, which is down 5%. And looking at large caps versus small caps, this definitely hasn't reversed course. So we talked about US versus international, that big reversal with international taking a leadership role so far this year. This is a continuation of a trend we've seen over the past 15 years with the largest stocks in the US stock market trouncing the smaller stocks, and now this is at its highest ratio. So the S&P 500 to Russell 2000, highest ratio we've seen since April 1999. And you can see here US small caps lagging in the red and international developed leading everything up 22% in terms of this VEA ETF. And I just want to end this equity section showing you the record concentration at the top of the US stock market. Stunning to see here. NVIDIA, this is looking at the top holding in the S&P 500 going back to 1980. So the biggest weight in the index. And NVIDIA has broken the record, which Apple actually set last year at 7.6%. NVIDIA now is over 8% of the S&P 500. That's a record with data going back to 1980. If we look at the top two stocks, so NVIDIA and Microsoft, they're now over 15% of the S&P 500, also a record going back to 1980. If we look at the top three, so now we're bringing in Apple, we're at over 21% of the S&P 500 in just these three names. That's also a record going back to 1980. And here we're broadening it to the top 10 names in the S&P 500. Now 38% of the index, highest level that we've ever seen with data going back to 1980. So in terms of the equity market, we're seeing one big reversal in terms of international stocks outperforming US stocks, but the other areas in terms of growth versus value, in terms of tech versus the broad market, and in terms of this concentration at the top of the US market, all of these are trends that we've seen over the past decade, and they're continuing so far in 2025. So how does all of this fit into your portfolio, your financial plan? Reach out to us today at creativeplanning.com/Charlie for a free wealth path analysis. We can help you with everything in terms of your investing portfolio, taxes, estate planning, and more. creativeplanning.com/Charlie. Get a free wealth path analysis. In creative planning, we're in all 50 states, so we likely have a location right near you. Over 370 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. Now let's move on to the bond market, talk about the Fed, inflation here. Longest bond market drawdown in history continues here. 60 months, so over 5 years of drawdowns for the US bond market. We haven't seen anything close to this in history. Before this, the biggest and longest drawdown occurred during the early 1980s, the longest being 16 months in duration. So we're well past that, over 5 years. And you can see here by the drawdown chart, we're still 5% below the all-time high. So while the S&P 500 has hit 15 all-time highs this year, 57 last year, and the market is up substantially over the past few years, the U.S. bond market, very different story, still clawing its way out of this enormous drawdown, which really started because yields were at record lows. You had the 10-year Treasury yield below 1%. 30-year Treasury yield actually went below 1% as well. And interest rates have risen from those record lows, causing this painful and punishing drawdown. So about 5% to go. And at current interest rates, take about a year to get back to even a little over a year, assuming interest rates stay where they are. If interest rates obviously fall dramatically, it could be shorter than that. If interest rates rise, it could take longer than that. If we're looking at the U.S. aggregate bond market, where current yield is around 4.4%. And it's been a pretty good year for the bond market so far. So we're in August here, up 4.7%, definitely punching above its weight. And that's because yields on the long end in terms of the 10-year have fallen, and shorter term yields have fallen as well, because people are starting to expect the Federal Reserve to resume its rate cuts. But looking at the bond ETF returns here, you can see mostly positive. Emerging markets at the top of the list, followed by the 7 to 10 year treasury and investment grade bonds, high yield bonds, everything performing pretty well. The longest duration bonds, zero coupons, lagging a little bit because we've seen those 30-year plus yields remain elevated, actually higher a little bit on the year. But if we're looking at the 10-year treasury yield, you can see lower here on the year at 422. We're seeing real yields start to come down here back below 2%. And at a 4.2% 10-year treasury yield, what does that mean for bond market investors? Well, it means that over the next 7 years, that's about what you should expect in terms of return. So we're pretty close here between the third decile and fourth decile. So anywhere between 4 and 5% returns would be the expectation. You can see here the correlation between the starting yield and forward bond returns, 97%. So unlike the stock market, the single best predictor of future returns in terms of the bond market is where that starting yield is going to be. The stock market has many, many more factors driving returns. The bond market over the long run, very simple. In the short run, it's dictated entirely by the direction of interest rates, but in the long run, it's that starting yield that really matters. So your expectation should be between 4 and 5% if you're a longer term bond market investor. What's helped with high yield bonds so far this year is credit spreads staying low. They widened briefly during that bear market, but came right back in below 3% in terms of the high yield credit spread. So very low default risk being priced into the market. The historical average is around 5.25% for high yield bonds, and you can see we're well below that today. So a lot of optimism in the stock market and in the credit markets. Investors not betting on a recession or default cycle looking at the current spreads right now. If we're looking at the yield curve in the US, 10-year minus 2-year, you can see steepening a little bit here. You got the 10-year yield down, as we just mentioned, on the year. It's at 422 currently, but the 2-year treasury yield down even more at 3.69%, and that's pushing up the yield curve a little bit. And why is the 2-year yield moving down faster than the 10-year? Well, that's driven by rate cut expectations in terms of the Federal Reserve. And after the weak jobs report that we got last week, what investors are betting is that the Fed will cut rates at least 2 times this year. They're showing a slight chance of maybe 3 rate cuts, but 2 is the base case, I would say, expectation, with the first rate cut coming in September and potentially in October as well. If we're looking at the Fed funds futures, over a 90% chance now that the Fed will cut interest rates in September. And as I always say, this is only important when you get very close to the meeting, but if it's anywhere near this 90% level a few days ahead of the meeting, the Fed will most definitely cut, because they always look at what the market is doing. They haven't disappointed the market since 2009. They've done exactly what the market was expecting every single time. And if you look at that October meeting, close to a 50-50, a little bit above there in terms of getting another rate cut at the October meeting. And if we go back to the Fed's June projections, this would actually be right in line with what they were saying in terms of where the Fed funds rate would end the year. They were projecting 2 rate cuts this year. So we'll see at that September meeting, they're going to update these projections. And of course, at that point, there will only be 2 more meetings to go. So it'll be very important to see if they maintain this or they change this in terms of the expectations. But back in June, they were essentially saying, despite their expectation that inflation is going to rise, they were still going to cut rates because they're expecting growth to slow down this year and the unemployment rate to go up. And really what the Fed looks at most closely is this core PCE inflation rate. And even though they have a 2% target, by cutting interest rates in September, what they're essentially saying is they don't need to get to their 2% target. There's enough of a cushion here between the Fed funds rate and that core PCE rate that they can bring this down. Of course, they're going to say they expect the core PCE to move to 2% eventually, but they don't seem willing to wait for it to get to 2%. Of course, they already cut 100 basis points last year without it reaching 2%. And If you've been watching the weekend charts, you know my argument. I don't think a rate cut is justified here. Inflation is nowhere near 2%. If we're looking at the last 5 years, we've more than doubled 2% in terms of the annualized CPI, but I don't think the Fed is going to be looking at this chart or talking about this chart. What they're going to be saying is that the labor market is weakening, and they're going to be saying that we're close enough to 2% in terms of inflation that more rate cuts are warranted. So it seems pretty likely as things stand today that the Fed will cut rates in September. Of course, we're going to get a CPI print between now and then, and we'll see what the market's reaction to that. But it doesn't seem likely that that CPI print is going to be benign enough to suggest that we're moving to 2% anytime soon. It seems more likely that the Fed is simply going to ignore that 2% mandate and resume the easing cycle in September. Let's move on to real estate and the housing market here. First, we'll start out with REITs here. The VNQ ETF still in a drawdown. So unlike the U.S. equity market, which has hit 15 more all-time highs, REITs an 11% drawdown still here off of its high. And its high was reached in early 2022. So we had that bear market. You can see in the U.S. stock market, REITs were hit even harder. Interest rates were rising, of course, them hitting the REIT sector particularly hard, and it still hasn't recovered here. So we're talking about an over 3-year drawdown for the real estate market here. And what's driving that is, unlike the residential sector, which continues to hit record highs in terms of home prices, the commercial property market is still well off of its peak from 2022. You can see here about 18% off of its peak from back then. And if we're looking at real estate versus the broad market, so real estate versus the S&P 500, you can see at its lowest level in terms of this ratio since 2000. So very interesting to see that. Of course, that coincided back in 2000, the peak in the dot-com bubble, and you can see, of course, real estate bubble took hold right as the dot-com bubble was crashing. You saw the real estate bubble start to develop, and you can see the outperformance from real estate. But over the past few years, it's been all about the broad U.S. equity market, large cap U.S. growth, tech definitely outperforming everything else, and REITs lagging here to a large extent, still in a drawdown. Let's talk about the housing market here. You can see affordability still is the big issue. The affordability index among its lowest levels ever. If you're looking at the Case-Shiller National Home Price Index, hitting new highs on a not seasonally adjusted basis. If you seasonally adjust, starting to come down just a little bit here over the past few months. This data is a little bit delayed in terms of Case-Shiller, so it's as of May. But if we're looking at the last 10 years, what's really caused this affordability index to plummet and to hit record lows is the fact that home prices have far outpaced wage growth. So you can see over the last 10 years, U.S. home prices on a national basis up over 90%, more than double the increase in U.S. wages. And what that has caused is the most unaffordable housing market in history. So much, much worse than what we saw during the last housing bubble in the mid-2000s. We're seeing a 57% affordability gap. So you need about $125,000 in terms of qualified income to afford the median price home for sale. And what's the actual median household income in the U.S.? It's about $79,000. So 57% above what the actual income is what you would need. And that's, of course, an untenable situation that would require you to spend over 50% of your income on just your housing payment alone, which, needless to say, wouldn't qualify you for most mortgages. And you wouldn't want to do that anyway because it's crowding out all of your other spending. You wouldn't be able to save or invest anything. But this is just an incredible chart to see 53% of your income you would need to afford the median priced home for sale, looking at just the median income. And the good news here is very slowly we're seeing a normalization in the housing market. We're seeing more supply in terms of listings, and we're looking at month supply in terms of new homes and existing homes rising all year long. You can see here listings up about 9% year over year. And what that's causing is more sellers than buyers, and that's starting to put pressure on home price appreciation. So you can see the Case-Shiller National Index is now up 2% year over year, slowest growth rate in a few years. And there are actually some cities now that are in the red looking at the last year: Denver, Dallas, San Francisco, Tampa. You can see over the past 3 years, you have Seattle, Portland, Phoenix, Denver, Dallas, San Fran, and all in the negative territory. And now it's been a few years for a few of these cities since they've hit record highs. So the notion that home prices only go up, they said that during the last housing bubble. They're saying that again today. It's absolutely, of course, not true. It's particularly not true when you have this situation where it's so unaffordable and you have supply starting to rise and demand still pressured by that lack of affordability. So it wouldn't be surprising to see this trend continue and to see, even if we don't have the declines that we saw following the last housing bubble, to see a long period of below average growth for the housing market would not be surprising given what we've seen over the last decade with this enormous appreciation outpacing people's wages. If we look at the rental market, here's the good positive story. If you're waiting to buy a home and you're renting, that rent has become more affordable over the past few years because rents actually peaked on a national basis over 3 years ago in summer of 2022. You can see here rents are actually lower than they were back then. So unlike home prices, which have continued to rise, rents are actually down over the last few years. And you can see here, now we have 26 consecutive months where we've seen a year-over-year decline in the national average rents. So very good news. If you're waiting to buy a home, your wages are still going up, rent prices are flat or down. That means each and every month rents are becoming more affordable. And this trend should continue as long as the supply-demand dynamic remains as it is. Here you can see the vacancy rate among multifamily homes, 7.1%, the highest on record. Apartment List has data going back to 2019 on this statistic. So as long as we have more supply than demand in the rental market, you're going to see continued pressure in terms of those rents. And that's good news, of course, for anyone renting. So let's talk about commodities here. Gold has been the big story so far this year, on pace for its best year since 1979, up 29% on the year. Of course, 1979 was a ridiculously strong year for the gold market, but pretty incredible to say here in August that at this pace, this would be the best year since 1979. If we're looking at gold versus broad commodities, strong outperformance over the past few years, strong outperformance year to date. So gold very much doesn't look like your average commodity. It trades very differently. Correlation is very low to most other commodities. So gold is its own animal. If we look at the last 10 years, you can see the equity market still outpacing gold, up 263%, though the gap is closing here. Gold up about 199%, and the broad commodities ETF up 62%. Speaking of that broad commodities ETF, it has not been additive to a portfolio whatsoever over the past 20 years. It came out about 20 years ago. It's about at the same level it was back then, with obviously huge swings in both directions. Past few years just simply going sideways. Commodities over the last year, again, gold among the big leaders, silver as well, 39%, lumber, 30%. And then on the downside, and this is really helping with the inflation picture, you have heating oil, you have gasoline, you have WTI and Brent crude all down on a year-over-year basis, and that's been helping CPI, and it will continue to help CPI when we get that July number. So if we're looking at gas prices here, actually down 8% year over year. You can see very steady on a year-to-date basis, not much movement at all at $3.16 a gallon for the national average. Let's talk about currencies here. US dollar has been the big story. Worst first half of the year ever for the US dollar index, down over 10% in the first half of the year. So far in July and August, a little bit of a recovery, but remains pretty weak. This has helped U.S. equity investors who have invested outside the U.S. in terms of international equities, because you get that appreciation on top of your return. And so this has definitely helped with that chart that I showed earlier of global equity returns. If we look at the last decade, nothing to talk about in terms of the dollar index, flat now over the last decade. The dollar had been outperforming, you can see, for most of the last decade, but now pretty close to flat on a decade base. And if we look longer term, since the early 1970s, the dollar index has pretty much gone nowhere overall, but huge swings and huge rallies and huge declines in both directions. Where will the dollar go from here? Nobody knows. A lot of predictions, a lot of guesses in terms of currencies. Very hard to predict where they're going to go. There's many different factors that are influencing a currency versus one currency versus another. One of them would be interest rates. So some might suggest, why is the dollar weakening here? Well, perhaps it's because the U.S. central bank is about to ease, whereas perhaps some of its competitors are done easing. If you look at the Bank of Japan, they're actually one of the few banks that have been tightening monetary policy. The Eurozone has already eased a bunch. So perhaps in anticipation of the Fed catching up and easing and moving this Fed funds rate lower, perhaps that's part of the dollar decline story. Of course, investor flows, another part. We're seeing fewer inflows from foreign investors into U.S. Again, many different factors driving a currency in the short run, but it will be interesting to see the last few months of the year if the dollar starts to weaken even further, given the Fed is going to cut interest rates, or that's already priced in. I think a lot of that will be dependent on what the Fed projects for 2026. What the market's betting right now is that the Fed is going to cut 3 more times in 2026, but if the Fed kind of changes that market's expectation, you could see a big move in the currency markets as well. So let's move on to crypto here. Bitcoin, of course, hitting more record highs this year. Ethereum had been lagging, was down over 50% just a few months ago on the year, has rallied and is now positive year to date. So huge recovery in Ethereum, which is the second largest crypto coin. The two of them together, 72% of the crypto market. Bitcoin, of course, hitting more milestones in July, just a huge advance when it hit record highs there at 123,000. It went up as high as, and now it's pulled back a little bit from those levels. The reminder in terms of Bitcoin, very volatile asset here. You can see the historical declines much bigger than the U.S. equity market, and it's had declines of 80%, above 80%, 90% in its history. And even this year, it had a decline of over 30%, and it bottomed right near the U.S. equity market's bottom, which is notable because as I've been talking about, with the financialization of Bitcoin, it's trading more and more like the U.S. equity market, so much more correlated, given the fact that you have all of these Bitcoin ETFs is being used more in risk-on types of situations. So you tend to see Bitcoin on big down days be down bigger than the market. On big up days, you're seeing Bitcoin be up more than the market. So it's really become a higher beta play in terms of risk appetite for investors. We'll see if that continues or it won't, but definitely you have to say that the financialization of Bitcoin has changed the way the asset class has behaved. If we look so far year to date, Bitcoin up 26%. That follows 156% in 2023, 121% in 2024. And as I just mentioned, Bitcoin's been really the magnification of the U.S. equity market in recent years. So strong returns from U.S. equities in 2023, 2024. Bitcoin far outpacing that. The S&P 500 was down 18% in 2022, and Bitcoin much bigger decline. S&P 500 down in 2018, Bitcoin much bigger decline. So interesting to see that correlation continuing to rise in terms of Bitcoin and the S&P 500 and the NASDAQ 100. Let's talk about intermarket analysis here, just looking at stocks versus bonds, record high. The correlation, though, between stocks and bonds was at a record entering the year and early in the year. Over the past 3 years, they had moved together like never before. So you saw the highest correlation in terms of the U.S. stock market and the U.S. bond market that we've ever seen. And slowly now it's coming down, which simply means they're starting to act differently. Stock market up, bond market down, and vice versa, just not moving in tandem. And I think the big reason for that is the fear of high inflation is starting to wane here. The reason why they were moving together in tandem was that big fear over inflation, and the stock market would correct as it did in 2022 when inflation was spiking, when interest rates were spiking. So that was causing pressure on the bond market. This year, more normal relationship in terms of in April, when investors were fearing a recession, you saw bond yields fall, you saw bonds rally, and you saw the US stock market fall. So what we're seeing over the past year is this correlation between stocks and bonds starting to come down here. And you're seeing a more typical relationship, I would say. The fact that they were moving so closely in tandem together, definitely not normal. If you look at the last 5 years, stocks and bonds, there's no comparison. The stock market has more than doubled. Looking at the S&P 500, and bond market's still down, as I mentioned earlier, still in that drawdown, down still on a 5-year basis. Stocks versus commodities at a record high. Biggest factor in this commodities ETF would be crude oil. And so you saw crude oil not participating in the advance this year, down a little bit on the year. And you see the stock market in the US going up, and that's driving this ratio higher. Looking at stocks versus gold, you can see gold early in the year was strongly outperforming, so we saw this ratio really go down, and the S&P 500 has recovered, and gold has kind of gone sideways over the past few months. So this relationship has recovered a little bit. Bitcoin versus the stock market's really a story of just Bitcoin, given how volatile Bitcoin is. It dominates this chart. So when Bitcoin's rising, this ratio tends to rise. When Bitcoin's crashing, this ratio tends to fall. And you can see here, we're just off the record high in terms of Bitcoin versus the US stock market. Looking at asset classes as a whole here, almost everything positive in 2025. Small caps, the exception here. I think this is actually turning positive as I'm talking now on Friday here. So almost it should be by the end of the day, perhaps 100% of major asset classes positive in 2025, with gold and Bitcoin leading the way. And why are those two leading the way in terms of narrative? I'd say a big part of that is the continued story about deficits and debt and the money supply continuing to go up, hit record highs in the US. Let's end here with the US economy. The economic expansion is still intact. We got the Q2 GDP number recently, and so now we have 62 months in terms of the US economic expansion, over 5 years old. The average post-World War II expansion is about 67 months, so we're almost approaching that. Does that mean it has to stop at that point? Absolutely not. We've seen an expansion as long as 128 months from 2009 to 2020. So this absolutely could continue for years more, or of course could end this year. Nobody's very good at predicting this, as we've seen in recent years. If we're looking at the GDP number here for the second quarter, 3%. This was expected to bounce back, but it was above expectation. So we had the decline in the first quarter, the bounce back in the second quarter, and really the story has been all about trade, all about the net export number. And in the second quarter, as expected, net export's a huge positive contributor. Companies working off that inventory number here, so that was a detractor. So really the opposite, the polar opposite of Q1, where we saw that negative GDP number because net exports went down. And if we look at the trade deficit here, this is fascinating. The trade deficit is actually up 38% year over year. So one of the big reasons for the tariff policy was to kind of address the record trade deficit entering the year. And what has happened so far this year is the trade deficit has actually widened because companies have tried to front run the tariffs. You could see what they did in January, February, and March. Huge increase in the trade deficit. And so year to date, just looking at the first half of this year, the trade deficit's actually up 38% versus where it was a year ago in the first 6 months. So fascinating to see. We'll see in the third quarter if this starts to normalize and we start to see lower numbers in terms of this deficit. But really, this is the big story driving those GDP numbers, the fact that we had that huge increase in imports in January, February, March. You can see it here. And if we look on a year-over-year basis, it's still well above where we were last year. So this is distorting all types of numbers in terms of economic data. This is part of the reason why it's very hard to say what the impact in terms of prices will be for tariffs, because we aren't yet seeing companies en masse have to replenish those inventories because they loaded up so much in the first few months of this year. So in the third quarter, probably at some point, we'll start to see more of those impacts. So it'll be interesting. This will be the most important numbers to watch in terms of these trade numbers. Are we going to see imports plummet? Are we going to see more companies try to pass on the tariffs to the end consumers, or are companies going to take a hit to their profit margins, either the seller overseas or the U.S. importer? That remains to be seen who's really going to bear the brunt of the tariff hit. If we look at the forecast for the third quarter, the Atlanta Fed's saying GDP growth is going to continue. They're projecting, as of now, this is still very early, 2.5% for real GDP. You could see the blue chip consensus here is saying it's going to be much lower, below 1%. Atlanta Fed did a pretty good job, I would say, in the second quarter. The projection was pretty close to that 3% GDP number. So we'll see if the blue chip economist will raise their forecast or this Atlanta Fed number will come down. In terms of the unemployment rate, that ticked up a little bit in the last jobs report to 4.2%, still well below the historical average, 5.7%. We have 55 consecutive months of jobs growth in the U.S. That's the second longest streak of jobs gains in history for the U.S., but jobs growth is slowing. So 1% increase over the last year is the slowest growth rate we've seen in a few years. So that extremely tight labor market that we saw a few years ago, not seeing that at this point today, but we're also not seeing massive layoffs. We're not seeing jobless claims spike. They're still trending lower. So what we're just seeing really is a slowdown in terms of hiring. We now have 3 straight months below 100,000 jobs in terms of new jobs added for the U.S. economy. We haven't seen that in some time. We obviously had huge revisions in the last report in terms of the jobs numbers. So there's going to be a lot of focus, of course, I think, on the next report to see if some of those revisions will move back in the other direction. I want to end with the most important chart for an economy, and hopefully this continues for the remainder of the year. We now have 26 consecutive months where wages in the U.S., so wage increases, have been outpacing inflation. And this is great news for the American worker because it increases your purchasing power. When you have this positive number, we're likely to have another positive number next month because we now have the wage increase at 3.9%, and inflation is expected to be between 2 and 3%. So we're likely to have a 27th consecutive month where we're seeing this positive. And this is really the big driver of everything for the economy. The U.S. economy is very consumer driven, and the consumer will continue to spend as long as they have a job, as long as their wages are outpacing inflation. So hopefully this is a trend that will continue. Awesome. So let's end it right there. Thank everyone for joining me on this special edition, State of the Markets, August 2025. I'll see you next time on the regular weekend charts. If you're watching this on YouTube, take a moment, hit that subscribe button for all the latest content from us. Have a great weekend, and I'll see you next time on the Weekend Charts.